Good morning, everyone, and thank you to the panellists for joining us today. So firstly, thank you to Steve and the whole team at Wholesale Investor for inviting us to have this panel here today and to be hosting here at ASX. So my name's Kate Galpin. I'm a manager in the listings team here at ASX. So my role is basically to engage with growth companies, mostly in the technology and healthcare sectors, and their investors in terms of working towards a public market listing and educating them on that pathway to using public market capital to move towards an IPO. We've got three great investors here on the panel today, and we're really lucky to have three investors all sitting at the cusp between private and public markets. So I think we'll have a really interesting discussion on that transition to later growth stage investing and then into pre-IPO and eventually IPO investing. So firstly, I might just work along the panel and get you guys to introduce yourselves, your funds and your investment focus. Bo, should we start with you?
Yeah, good morning, everyone, and thank you very much for being here, Kate. I'm Bo Huizinga, partnered with Winala Capital. Winala Capital is a late-stage investor. We typically invest in businesses that are looking for a liquidity event within the next 2 to 3 years after we made our investment. We like to back winners in digitization and supported by long-term growth trends like data, B2B software, and fintech. The fund has been around for almost 4 years. We have made 25 investments to date. We have realized 12 exits. And we have realized an average IR on those exits of roughly 40%.
Hi, I'm Karen Chan. I'm a portfolio manager with Perennial Private. We invest in growth stage, pre-IPO, IPO as well as placements. We think of ourselves as crossover investors able to support founders and management teams from private through to public, and then have the full support of the Perennial Partners family of funds.
Thanks to Wholesale Investor and ASX for the opportunity today. My name's Rajiv from Allium Capital. We've been around for 8 years. Our first fund was a $100 million fund. We returned back $150 million to investors and returned about 3 times their money. We are focused on all stages, but we are very liquidity focused, and in that first fund we had 37 exits.
Great, thanks guys. So let's jump straight into it. The topics we're going to be covering today are around macroeconomic market outlook, liquidity, valuations, and then touching on the end on some fund structure as well. So let's start with the global macroeconomic environment. I'll give you a quick overview of where we sit from the IPO market. So obviously still a relatively subdued IPO market, and that's despite seeing many markets this year hitting highs, ASX included, more stability in the macroeconomic environment and volatility still sitting quite low. What we are seeing ourselves, and obviously one of the first listings of size late last month was Tasmea, which was an oversubscribed raising, and it's been well supported in the aftermarket. So there is interest for deals coming through. Tasmea was actually postponed from late last year when there was obviously more volatility and less certainty in the markets. So from an ASX perspective, we're expecting to see some more activity towards the end of this year, hopefully, including some of those larger deals that we all saw were postponed in the last 18 to 24 months. So let's get into the current macro environment. Raj, I might start with you. What are you seeing in terms of deal flow yourself across the portfolio, and what's your feelings towards the macroeconomic environment and the general market?
To give it a bit of context, Kate, 21 and 22, it was very difficult for us to put our hands in our pocket and invest. It was overheated, deals were closing extremely quickly, and people were raising far too much money, but everyone in this room knows that. Over 23, particularly the second half of 23 and 24, we found it to be much more attractive. Deal cadence is more normal. It's not a deal opening on Monday, closing on Friday. We've been negotiating with a company since September of last year and we still haven't closed, but that is a normal deal cadence because it's about understanding the business in detail. It's about negotiating with the counterparty or the founders or the board. So we feel deal activity now is like it was when we founded the fund back in 2016. We think it will only get better because less people are generally supporting new businesses. A lot of investors and a lot of funds that all of us deal with at the earlier stage are supporting their existing assets more so than new assets. So for us, when we launch this new fund, new assets at good prices with good outcomes is what we focus on. And I think the environment has certainly improved and looks a lot better now.
I'd like to add that the confidence has definitely returned to the market. I think you would all have seen in the first quarter of this year, there's been a lot of M&A transactions, particularly in the public markets. I guess it raises the questions of what does that mean for the ASX? But we actually think that it will be positive for new issuers coming to market, as listed fund managers would be looking for new ideas. The fact that I think boardrooms now have confidence to actually transact also shows that there's more confidence around the macro environment, even though the rates are definitely higher, maybe higher for longer, but they've definitely settled from the last 18 months where you've had successive rate hikes, and there was just no clarity over when that rate hike would be stopping.
Great points. I think that kind of when looking at the market right now, I think what has come into place that we have seen more realistic realizations of structure. So it is more attractive for us as an investor to look at where we can negotiate on certain pricing, certain structures, certain points, and I think that founders are more open to support that and to create a deal that will benefit everyone in the long end.
Thanks. I think that leads us on nicely to the next topic, which is valuation. So Karen, I might open up with you here. I'm sure in the audience today there's a few founders that are starting to think about fundraising and what the environment might be like out there. So it'd be just good from getting input from you as to what are you seeing with your own portfolio companies on the front line in terms of raising, and do you think at different stages at the moment within the market there's more openness, less openness to support fundraising?
I think we're definitely seeing activity across all stages. There's definitely a lot more activity at the earlier stages and less at the later stages. But we are starting to see companies think about pre-IPO rounds, which we think is really positive. From a valuation standpoint, we've really seen multiples contract from the frothy peaks of 2021. Within our portfolio, we've seen multiples contract anywhere between 15 to 70%. So it really depends on company-specific factors as well as the industry in which that they play in. We're also seeing that many of our portfolio companies have been able to grow through the current cycle. So that's actually also helped manage valuations as well. So some of them have managed to maintain or grow their valuations despite the valuation multiple contraction. One of the positives from the multiple contractions is that we're now in a more normalised sort of environment. So we're seeing multiples now being closer to where they were pre the COVID levels.
Yeah, and I think especially in the later stage scene is that the supply for cash is still low. So there's currently kind of 3 times as much demand for capital than there is supply. So I do think looking at the valuations of these later stage businesses, they need to be more connected to the listed environment. And I do think that they have come down a bit from where they were, in 21 and 22. But to Karen's point, I think that the majority of the businesses have been showing, strength in their growth, and they have been continuing doing what they're good at. So they have been growing into valuations, but it's definitely a more attractive space to be in right now as an investor in 24 than it used to be 2 years ago.
I'd add that there's a 2-speed when it comes to valuations. 21, 22, as we know, doesn't matter how fast you were growing, how much money you were losing, everything was expensive. Over the last 18 to 24 months, companies that are growing very quickly, that are showing a path to profitability or are profitable, are still very expensive, and everyone wants to own those. There is a pocket of companies that we have met over the last 12 months that are growing well, and I'd say 20 to 40% is good. Not everything needs to grow at 100% year on year. 20 to 40% consistently, not burning a lot of money, and showing a very clear path to generating EBITDA is paramount. So if you can have confidence in management, then those types of businesses you can negotiate and buy well, and that's critical.
Might drill down into some of those points as well, and Bo, to your point about sort of, later stage businesses. Just interested, across your funds, what are you guys really looking for? Raj touched on it a bit there, but in terms of that pre-IPO investment, how are you assessing opportunities that do come to you, and what are you looking for in your portfolio?
Yeah, so I think that we're looking for scalable businesses that have a growth track record, showing high growth, showing healthy high gross margins, companies in our particular case that are happy to create a liquidity event in the next 2 to 3 years. It's very important that they're aligned with us. We would never force it upon them, but we would like to support them if that's the route that they'd like to take. And I think what's important to us when we support a business is that they keep continuing what they're already doing. And to give you an example, when a company goes overseas, that they've already established an office, they've already hired some people, they've already signed the first 5 or 10 customers, and then we're very happy to back those companies and provide them with capital so they can continue doing what they're good at. And specifically on pre-IPO, I think when a company would like to list, it's important that governance is in place. So you have an experienced management team, they need to have good reporting, financials need to be audited, they need to have a professional board, and they need to be investment grade. And for our particular case, we'd like to see that the businesses are at a certain stage, that when they list, that it will attract banks to write research about them, because that will then attract institutional investors to back them. And we would also like to see that there is, hopefully a minimum volume on a daily base, so that if there are larger sells within the stock, that it doesn't cause any major swings in the share price.
Agree with the points that Bo's just raised. We also really care a lot about the founders as well as the management teams, because we see it as a partnership model that we have. And the day one of the investment, I think, is a honeymoon period. So we really care about what that relationship looks like in both the good and bad times. And so we're looking for founders that we can really work with. Because not everything is going to be linear or going up and to the right. So that's really clear for us. We also look to what the company's path is, so that we are aligned in terms of exit, because we do manage funds that do have a timeline, and if we're not aligned on that, then that's a real mismatch that will have repercussions in the longer term.
Yeah, for us, the outcome that Karen talks about is critical. You've got to have a strong sense of whether this investment is an M&A target for someone like Cameron and Pep, or for someone like Chris at Pi and others, or is it an IPO candidate? Whilst the IPO market, as Kate outlined and we've all read about and heard about over the last couple of months, has been tough, it will open up. It's the best way to democratize ownership of an asset, and people want to own stocks. That's how they've made money in the US, and I'm sure many of you do own stocks in the US. That will open up here again. So we think the outcome for public markets in the next 12 to 24 months will improve. In terms of what we look for, it's 3 Ps, people, product, price. So people is the founders that Karen mentioned. We always, given our focus on technology and innovation, it must be a technical founder. So we don't want someone who ran marketing at one of the big 4 running a fintech. We want someone that could actually get on the tools. So people is key. They must have a board. They must have a C-suite. So that is our prerequisite. The second is on product. If you're offshoring, outsourcing to India, Vietnam, or somewhere in Eastern Europe, we're generally out. We want the technical founders and the team that is technology focused to be sitting in the same office, be it in Sydney, Melbourne, Brisbane, wherever it may be. It is absolutely paramount, because I had a technology company, and that's where we made mistakes. It's when you give it to people that are not core to the business, things go wrong. And the third is on price. You've got to be very comfortable and disciplined in what you pay. We have always been seen to be a frugal investors, and it may upset founders when we enter, but we do try and add value and get them a great outcome, and hopefully our investors get a good outcome along the journey as well.
Thanks, Raj. So I might move on to liquidity now. So Raj mentioned the commentary around the IPO market, but there's also been a lot of commentary around liquidity for the VCs, particularly those earlier funds in the Australian market that are now reaching the end of their life or have moved into continuation funds. So I think it'd be really interesting to get your insights actually on where those VC funds are sitting at the moment. Does that mean there's opportunities for you guys at the next stage of the investment from some of their liquidity demands? And then also, how do you go about managing liquidity demands and returning capital back to LPs, and what's been your experiences through your funds in terms of dealing with that? Raj, I'll start with you.
It was never an issue until 2 years ago, but we fortunately, and my peers on this stage as well were similar, we're always very liquidity focused. We want IPOs, we want to trade assets. I'll speak for Allium. We are not a forever investor. In our first fund, our average holding was 3.7 years. No company should come to us thinking that we will provide capital for the next 10 or 15 years. We will definitely provide a lot of capital over the first 3 to 5 years, but we want to be able to trade out of assets because our fund is one that is seen to be a little bit fast, but the reality is people care about liquidity and cash. So for us, it's a situation of going to venture funds that are out there today, and if they are seeking liquidity, we will absolutely look to take them out if we think we can recycle that asset in 4 to 5 years. So there are some great opportunities in assets that were unicorns in Australia in 21, 22 that are now coming back at 40, 50, 60% discounts. The valuations are not unicorn-like, but what you're buying them at is justifiable. So I think for us, I know for us, creating secondary liquidity for other funds is important, and in the new fund, we will allocate 30 to 40% to do that.
I think it's just really healthy now that venture funds are also thinking about liquidity and returning capital to their investors. I think it goes to show that the ecosystem has really grown up now. And to have funds like ourselves that could be secondary buyers or investors to help these companies go to a listing, we think that's also really positive, just given that not every company can list on, say, NASDAQ, which is the North Star for a lot of these VC fund portfolio companies, where you really need to be like a US $5 billion company to really get investor interest, whereas you could be very relevant here in Australia. So we're here to support those companies.
Yeah, so again, to your points, the secondary market currently is very interesting for us. Definitely something that we look at. We see great opportunities. But I also think it's important, and that's also what we try to work with our companies, that right now, the last 2 years, yes, we have seen that the IPO market has been closed. We also know it's gonna open, but sometimes, times change, and it is good for a company if they have the ability to make that mind change and actually be able to search for a different type of a liquidity event. That could be a secondary itself, but it also could be a trade sale. And what we also try to do when we enter an investment is that we try to structure it in a way that there is a way that we can force a liquidity event if that's required. That will always be, in collaboration with the founders, but it also creates an opportunity with the founders to just, discuss and collaborate on where the future should go to.
Thanks, Bo. I might stick with you for the next question on that. You've touched on it there with the quieter IPO market, that exit route for your guys' portfolio companies has been more challenged. How has that affected your portfolio, and how has it affected how working with your portfolio companies through this period?
Yeah, I think, to give you two examples, I think at the back end of the first half of 22, there were two portfolio companies of ours that were well progressed into an IPO, and they had to withdraw last minute, and I think for all the right reasons. But I think founders are usually very inventive and capable, and there's always a plan B. So for me, the two main reasons why a company is listing is to raise additional capital. And whether you raise additional capital by a listing or by a private round, or you raise it with private debt, in the end, capital is capital, and that is used to support the business and to continue growing. And the second reason could be to create a liquidity event for early stage investors. What we've been seeing in our portfolio over the last few years is that the vast majority of the businesses were able to continue what they were doing. They were still growing well. They reached their budgets and their targets, and they were inventive and just looked for a different way to raise capital. In the last 2 years, we have seen quite a few private credit funds showing up that are happy to support capital to late stage businesses. But furthermore, we always like to support our businesses ourselves. If required in another private equity round, we could, a private round, or if it would have been a pre-IPO note, we could extend it and invest additional in the capital in the portfolio company to make sure that it will successful in the next year or so when it opens again.
And profitable growth is really important. So we've been at the board level, as well as a shareholder, advising our portfolio companies to really get to profitability if they're not there, because that opens up a lot more options. We also have experience as a corporate advisor as well across the team. So we have been advising our companies on potentially tying up, merging with other companies, being bigger, which would also help them to have more exit options, whether that's through M&A or through an IPO when the timing is right. So those are the two things that we've been focused on.
Great. Let's move on to fund structures now. So there's been some debate and movement in the market between more open-ended, evergreen style funds versus closed-end funds. So just really interested in your perspectives. What do you think are the benefits of different fund structures, and how do you see it playing out in the market? Karen, if I could ask you to start on that.
Thanks, Kate. I'm happy to kick this off. So we're in market with evergreen open-end structure. Our prior funds have all been closed-ended, and one of the benefits that we think there is with an open-ended evergreen structure is the ability for investors to think about portfolio construction and rebalancing, and being able to invest in the funds on an evergreen basis. What we mean by that is, if you were to invest in a closed-ended fund, if you miss out from day one, then there's no ability for you to get into that fund unless you're able to find existing investors to buy their stake. So we think that evergreen structure would also enable incoming investors to get access to a diversified portfolio from an asset as well as vintage perspective. So it's closer, you have assets in there which is closer to a liquidity event. So from our perspective, we're still looking to drive returns and distribution to investors, but thinking more about how we can enable investors who have liquidity considerations to be able to exit if they need to, but also have the ability to enter throughout the life of the fund. I guess one point to add to that is there is still liquidity limits. So for everyone looking at evergreen funds, you should look at the fine print as well.
So we had an open-ended fund and we closed it. We are moving to a closed-ended structure which will have multiple vintages inside. So effectively we're moving to a quasi-private equity model. The advantage we see with that is, so we're raising $250 million. We're going to do the first vintage, which will be $75 million. Investors come into that. And given that we've had the track record of exits and returning capital, when we exit out of that first $75 million, we'll give the money back to investors. So there won't be any recycling. And that's the issue we had with our very first fund, which was open-ended. You inevitably are recycling capital and not giving it back to investors unless they're redeeming. And so for the first 7 years of that first fund, which was 7 years old, the first 5 was beautiful, but the last 2 was a bit challenging, which is why we think this structure is beneficial to investors and the return profile.
Yeah, we also run an open-ended fund. We've been doing so for the last 4 years. I think one of the main advantages is that when investors would enter at a certain point in time, they already invest in a seasoned portfolio. They're kind of missing out on the J curve when, the first few years is kind of building up that portfolio, but they immediately have exposure to growing successful businesses. And I think furthermore, what we've been seeing in the market, when we make an investment and a company decides to list, at that point in time, we make a decision whether or not we would like to stay invested in the listed entity, but we could also decide to actually to sell our position because we have the feeling that there is a better opportunity in a private company. Whereas I think if it would have been a closed-end fund, we may be forced to hold on a little bit longer in the position. Because otherwise we need to return the capital. Whereas with an open-ended fund, the luxury that we have is that we can recycle the capital, and on a yearly basis we do distribute the profits that we make by realizing exits. And to give you an example, with a portfolio, in an ideal situation, we have roughly 20 to 25 positions. 1/3 of the portfolio is usually recycled every year, given the fact that we tend to hold positions for 2 to 3 years at a time.
Great, thanks guys, that's really interesting. I think time is coming up against us now, so we'll wrap up. But Raj, Karen, Bo, thanks so much for your insights today. For the audience as well, all 3 funds are currently fundraising, so if you're interested to find out more, please track down the guys after the session. I'm sure they'll be more than happy to have a conversation with you. Thanks, I'll hand over to Jade.